Hello everyone and welcome to the Finance and Risk Corner. Today we look at the difference between time-weighted and money-weighted rates of return, an important concept for quantitative methods and portfolio management. We will learn when each is appropriate and how to calculate them both. But let's first start with a more fundamental concept, one that is necessary for our future calculations, a holding period return. So what is a holding period return? It is simply the return that was earned during a specific period. And this period could be a year, a week, a day, or 6 days. So let's take a quick example. An investor bought a stock for $20, held it for 33 days, and sold it for $22. Also, the investor received a dividend of $0.5. The holding period rate of return calculates the return that was achieved over the 33 days, which is the investment period. So it is simply the ending value, both the selling price of the stock and any dividend that was earned, minus the beginning value divided by the beginning value. For a return of 12.5%, again, this is not 12.5% a year, this is 12.5% achieved over the 33-day investment period. The formula could be written as ending value minus beginning value divided by beginning value, or very simply, if you expand the formula, ending divided by beginning minus beginning divided by beginning, it would give you ending over beginning minus 1. So you are free to use any form of this specific formula. Both will give you the correct result. So it's either 22 plus 0.5 minus 20 divided by 20, which is the first form of the formula, or very simply 22.5, which is again the final value plus dividend, divided by the beginning value minus 1, which is this form of the formula. 12.5% is the holding period rate of return. Now that we have a series of holding period rates of return and we know what an HPR is, we are ready to understand time-weighted rates of return. A time-weighted rate of return is simply the geometric average of a series of holding period rates of return. So imagine we have 5 years and those are the holding period returns for each of those 5 years. So in year 1, the investor achieved 6%, 4% in year 2, minus 2% in year 3, 11% in year 4, and 9% in year 5. Again, the time-weighted rate of return is simply the geometric average of that series of holding period rates of return. We have covered the geometric average together in a previous video, so this formula has no secrets for us. By calculating the geometric average of this series of holding period rates of return, we get a time-weighted rate of return of 5.5%. This is the time-weighted rate of return. Now, what are the properties of the time-weighted rate of return? And it's very important to understand those properties. We have already established that it is the geometric average of periodic holding period rates of return. Now, the three next points are extremely important. The time-weighted rate of return is absolutely not impacted by the order of the holding period rates of return. In other words, it doesn't really matter which return occurred first or last. You can quickly verify this property by just recognizing that if you have A plus B multiplied by 1 plus A, multiplied by 1 plus B, multiplied by 1 plus C, you'd get the exact same answer if you say 1 plus C multiplied by 1 plus A multiplied by 1 plus B. So the order doesn't really matter. Now, in more practical terms, it doesn't really matter whether the 6% was achieved in year 1 or in year 4. It also doesn't matter whether the 11% was achieved in year 4 or in year 2. The order of the returns does not impact the final value of the time-weighted rate of return. But more than that, the time-weighted rate of return does not consider any addition to or withdrawal from the account. Both the size or the timing of such additions and withdrawals are not really taken into consideration when we calculate a time-weighted rate of return. And you can verify one more time, I did not use, or the information regarding how much money was in the portfolio was absolutely not given in this example. I don't know whether $1 million earned 6% in year 1 or $500,000. I don't know if at the beginning of year 3, the investor had $2 million, $5 million, or if the investor added some money to the portfolio, or on the contrary, withdrew some money from the portfolio. The amount of money that is in the portfolio is irrelevant when calculating time-weighted rates of return. And this is something that is fundamental. The time-weighted rate of return does not take into account whether the investor adds some money to the portfolio or withdraws some money from the portfolio. Both facts are somehow very much prevalent in real life because investors do add money to their investment portfolios, and whenever they need liquidity, they do withdraw money from their investment portfolios. So when do we use the time-weighted rate of return? There is nothing to memorize here. If this metric, which is time-weighted rate of return, is actually not impacted by when and if and how much the client deposits to the portfolio or withdraws from the portfolio, then this measure should only be used when the portfolio manager has no control over the size and timing of any addition to or withdrawal from the portfolio. So if we have client A who started investing $1 million and the portfolio management is portfolio management M. Now, year 2, the client A is happy with the performance of portfolio manager M, so he deposits 0.5 million into the portfolio. And then in year 3, client A needs some money, so he withdraws $200,000 from the portfolio. It is the client's decision, it is the client's discretion whether he or she would actually deposit money or withdraw money from the account at any point in time. The manager does not control this fact of the client depositing or withdrawing money. The manager has absolutely no control over either the size, the timing, or the reasons why the investor would actually deposit or withdraw. Whenever this is the case, the time-weighted rate of return is the fair return to actually calculate. Because if you are comparing the performance of two managers, manager M and manager N, you cannot use a measure that is actually changed or affected by decisions that are outside the control of those managers. So if you were to compare the performance of managers M and N, you must use a time-weighted rate of return if it is the client who controls when and how much to add or reduce the portfolio or to withdraw from the portfolio. Because if you don't do that, then one of the managers will actually appear to be outperforming the others, but purely for reasons that are outside the control of the manager, and you should not really give them credit for this outperformance. This is why time-weighted rates of return are used when the manager has no control over when and how much the investor adds or removes from the portfolio. That's the second example to calculate a time-weighted rate of return. So you have a portfolio manager managing $20 million in year 1 at the beginning of year 1 for a holding period rate of return of 10%. So the manager achieved 10, 30, 15, negative 10, and 6 during the 5 years under consideration. Of course, we are given the amounts, the assets under management, but we know that this is a distractor. When calculating time-weighted rates of return, we don't really need the amount of money that is actually managed. So the time-weighted rate of return, one more time, is simply the geometric average, power 1 over 5, of this series of holding period rates of return, for a time-weighted rate of return of 9.42%. One more time, I cannot stress enough on that, you do not need assets under management when calculating time-weighted rates of return. All you need are the holding period rates of return. Let's move now to the money-weighted rate of return. The good news is you already know how to calculate the money-weighted rate of return because it's simply an IRR. It's the internal rate of return. So just like in IRR, it is the rate of return that makes the present value of inflows equal to the present value of outflows. So for a money-weighted rate of return, you actually do not need holding period rates of return. You need inflows and outflows. So one of the most important distinctions, a reflex that you really have to have on the exam, is that anytime you're calculating a time-weighted rate of return, you're really looking at the holding period rates of return and you want to geometrically average those. Whereas when you're calculating a money-weighted rate of return, please think cash flows. Don't look at holding periods rate of return. You might need them to calculate the implied inflows and outflows, but once you have the cash flows, you can calculate money-weighted rate of return. So it's exactly like an IRR. Now, because it's like an IRR, it does take into account, it is affected by both the size and timing of cash inflows and outflows. $100 received in year 1 is not the same as $100 received in year 5. And the MWR, which is an IRR, would react to both the size and timing of cash flows. So when do we use a money-weighted rate of return? We have the answer. Anytime the manager has discretion, anytime the manager has control over how much and when should the investor deposit more funds into the account, you should use the money-weighted rate of return. Because on top of the performance of the underlying assets, the money-weighted rate of return catches also the timing of the manager, whether that timing was adequate or not. And when I say timing, I mean the timing of additional deposits or withdrawals to or from the account. So if you're comparing managers A and managers B's performance to pick one of them, to decide between one of them, if managers A and B have control over the size and timing of cash flows, a simple example would be if A can call the client and say, you should now deposit $500,000. You should now deposit $200,000 into your account because I believe that the next period will be better. So anytime managers A and B have control over the size and timing of cash flows, i.e. the money that the client deposits or withdraws from the account, then we should use the MWR. And if you're thinking, when is it the case that managers have control over when the client deposits money, think private equity. In a private equity fund, the manager of the fund first takes commitments from investors. So imagine this is the private equity funds and you have several investors, I1, I2, etc. The manager, which we call the general partner, will take capital commitments. So first, investor 1 will commit $10 million to the fund. It does not mean that investor 1 would transfer $10 million to the manager and the manager would start managing this money immediately. No. Investor 1 would simply commit to investing $10 million. So anytime the general partner or the manager will actually draw down capital or issue a capital call, then the investor has to honor their promise, honor their commitment, and actually transfer that amount of money. So it is the manager in the fund who from time to time will require the investor to transfer, let's say, $1 million. So the manager will ask the investor to transfer $1 million out of the $10 million that the investor committed. And then 6 months later, the manager might request an additional $4 million. You can clearly see that in this context, it is the manager who has full control of when and how much the investor should invest in the portfolio. Then when this is the case, only a money-weighted rate of return is appropriate because this is the only rate of return compared, of course, with the time-weighted rate of return. This is the rate of return that takes into account whether the decision to invest and how much to invest during that particular timing was actually a good decision or a bad decision. Of course, examples will make things much clearer. So let's look at an example where we see the difference between the time-weighted rate of return and the money-weighted rate of return in practice. An investor purchases a share for $100 today. At the end of the year, the investor purchases another share for $120, same stock, which means, by the way, that the stock appreciated from 100 to 120. At the end of year 2, both shares are sold for $124 each. At the end of each year during the holding period, a dividend of $2 per share was paid. Now think again, please. Anytime you want to calculate a time-weighted rate of return, think HPR. I need the holding period rates of return, and then I need to geometrically average those. And anytime you want to calculate a money-weighted rate of return, you need cash flows, inflows, and outflows. How much did I invest, and how much did I earn back as cash inflows? So this is why we have in this table both metrics. So let's look at it step by step. In year 0, which is actually the beginning of year 1, you bought one stock. So this is an outflow of $100. $100 would leave your bank account to invest it in that particular stock. So you have an initial cash outflow of minus 100. Now, they tell us that at the end of the year, the investor purchases another share for 120. This means that the share you initially purchased for $100 is worth 120 at the end of year 1. They also say that a dividend of $2 was earned at the end of each period. This will allow me to calculate the holding period rate of return for year 1, which is the ending value of 120. Remember that they told us that the investor purchased another share for 120 of the same stock, which clearly means that the stock is now worth 120. So the ending value is 120. The investor received a dividend of $2, so that's 122, and the initial beginning value was the purchase price of the share at the beginning of year 1, which is $100. The holding period rate of return is 22%. We have the holding period rate of return for year 1. Let's continue with holding period rates of return. Now, in year 2, at the end of year 2, both shares are sold for 124 each. Now, remember that at the beginning of year 2, I had 2 shares. Each share was worth 120. So my initial value at the beginning of year 2 was 240. Please do not use 100 again because you'd be double counting the return. The increase of the share from 100 to 120 was already captured during the return for year 1. It's as if you're starting from scratch now to come up with the calculation of holding period rates of return for year 2. So the beginning value is 2 shares which were worth at the beginning of the year $120. So the beginning value is 240. The ending value is 124 per share, so we sold both for 248. Also, don't forget that we earn a $2 per share per year, so that's a $2 times 2 because we hold 2 shares, $4 of dividends. The ending value is the selling price of 248, 2 times 124, plus $4 of dividends, 2 times 2. We can now calculate a holding period return for year 2, which is 5%. We can now calculate a time-weighted rate of return. So the time-weighted rate of return is simply the geometric average, which is 13.18%. Now let's move to calculating a money-weighted rate of return, and remember that we are mostly interested in cash flows, because to calculate money-weighted rates of return, all we need is to calculate inflows and outflows and find the discount rate that makes the present value of inflows equal to the present value of outflows. So back to the year 0, which is the beginning of year 1, there is an outflow of negative 100. This is where we bought the stock for $100. Now please remember, at the end of year 1, we decided to buy an additional stock. So we bought an additional stock for 120. That's a second outflow of 120 that leaves my bank account to acquire this second share. But don't forget that you also earned a $2 dividend, and this is a cash inflow. So this cash inflow needs to be taken into account, and the net cash outflow for year 2 is negative 118. Now for end of year 2, we have sold both shares for 248. So we have an inflow. The money flows back again into our account when we sell our 2 shares. And we also have $4 in dividends that were earned, for a total cash inflow of $252 end of year 2. We are now ready to calculate a money-weighted rate of return. So this is the rate of return that equates the present value of inflows with the present value of outflows. So you have minus $100, no need to discount it. It was paid at the beginning of year 0 or year 1. You have a negative 118 at the end of year 1, so it must be discounted for one period at the money-weighted rate of return. And then you have the inflows of 252 occurring at the end of year 2. They need to be discounted at the money-weighted rate of return to the power 2. Of course, you cannot do this manually. It's an iterative process. You take your financial calculator, you use your cash flow function, where C0 is negative 100, C1 is negative 118, and C2 is 252. Compute IRR, which is the money-weighted rate of return, 10.35%. Now we must stop for a second and understand what happened here. We have the exact same example, but if we choose to calculate the return in the form of a time-weighted rate of return, we get 13.18%. If we choose to present return as a money-weighted rate of return, we get 10.35%. So which one is correct? Again, the answer would depend on whether the manager, the person who is managing this portfolio, has control over when and how much is deposited to or withdrawn from the portfolio. So in this case, was it the investor who decided at the beginning of year 2 to inject an additional $120 into the account and purchase an additional share? Or was it the manager who has discretion over the account of the investor and who decided at that point in time that they needed to or they must invest in an additional share? If it was the client who controlled when and how much to deposit or withdraw from the account, then you need to use the time-weighted rate of return. Because one more time, it is not affected by how much money was at play when those returns were earned. Look at the holding period's rate of return. They absolutely don't take into account how much money was actually invested. They simply calculate the holding period return that was achieved for year 1 and that was achieved for year 2. Whereas the money-weighted rate of return is very much affected by when, how much, and in what period things would happen. If this actually happened in year 2 and this happened in year 1, then you would have had a different money-weighted rate of return. So if the manager controlled when to inject more money into the portfolio and how much to inject, then you would use a money-weighted rate of return. Another very interesting thing is to recognize that the two measures are actually not equal. In that case, the money-weighted rate of return, is actually lower than the time-weighted rate of return. And you should have an easy way to solve for that, sometimes without even calculating which one is actually higher. So let's look at this together. The money-weighted rate of return is the one that is impacted by when and how much you invested, whereas the time-weighted rate of return is not. So let's think of those 4 scenarios. If you deposit money just prior to a better than average performance, then more money would actually earn the higher return and the money-weighted rate of return would increase. Focus on the word money-weighted rate of return. It's as if you're saying, how much money did I have when I earned 22%? And how much money did I have when I earned 5%? And depending on what was the amount of money that was larger, right, you would get a different money-weighted rate of return. So a money-weighted rate of return is actually doing this. It is weighting your return by the amount of money that was at play, that was invested when that specific return was earned. So if more money was in the account when you earned 22% versus less money when you earned 5%, then the MWR will be tilted towards the 22. Bottom line, the money-weighted rate of return will react based on how much money was in the account when each return was earned. Please do remember that the time-weighted rate of return doesn't care at all. It is 1 plus 22% into 1 plus 5% geometrically averaged. So it does not factor in any way how much money was in the account when we earned 22% and how much money was in the account when we earned 5%. It does not factor that concept in. So only the money-weighted rate of return would actually react. This is why, think about it this way. If you had $100 and you earned 6%, and then you suddenly decide to invest an additional $1,000 and then you earn 8%, then the money-weighted rate of return will increase because it will move closer to the 8 rather than 6. Why? Because more money was in the account when you achieved 8 versus less money in the account when you achieved 6. So look at those 4 scenarios. This one first. If you deposit money just prior to a better than average performance, like in this case, the MWR would increase. The time-weighted rate of return is always not affected. But this means that the time-weighted rate of return will be higher than the money-weighted rate of return will be higher than the time-weighted rate of return. Now imagine you withdraw money just prior to a period of very bad performance. This is also something that is positive, right? So imagine you invest $1,000 and you earn 7%, and then you have a bad feeling about the markets, you withdraw most of your money, you only keep 200 invested, and then you earn -4. The money-weighted rate of return will actually be better than the time-weighted. The time-weighted will simply be the geometric average of those two. We already are experts in the time-weighted rate of return, right? But the money-weighted rate of return will actually catch this positive timing because it recognizes that you had more money earning 7% and you had less money, much less money, earning the 4%. So the average will be closer to the +7 rather than the -4. So the money-weighted rate of return will increase. One more time, try to appreciate how the money-weighted rate of return is impacted by when the returns are earned, how much money did I have into the account, did I add money, did I withdraw money, and were those decisions good decisions or not. The money-weighted rate of return catches all these concepts. So withdrawing money just prior to a bad outcome is good because you allow the portfolio to lose less. Now, the bad scenarios would be the bottom half scenarios. Imagine you just deposited money prior to a worse than average performance period. So you had $2,000 invested and you earned 11%. You decided to add more money, right? So you now have $6,000 in the account and you only earn 4. You only earn 4. So again with the example, excuse me again for that. So you had invested $2,000 and earned 11%. You decide to invest even more, so you now have $6,000 in the account and you only earn 4. This means that much more money was invested when you earned the lower performance, the lower return. The MWR would be closer to 4 rather than 11. Again, always and always, the time-weighted rate of return is not impacted. It doesn't care. It's just the geometric average of 11 and 4. So in that case, depositing money prior to a period of lower performance would actually lower your MWR. A second bad outcome would be to withdraw money prior to a better than average performance period. So take the opposite example where you had $2,000 invested and you earned 11%. For some reason, you had a bad feeling about the market, so you decided to withdraw part of your money or most of your money. You only kept $500 only to see that the return was 26% on those $500. You probably, right, regret this decision because much less money was in the account when the higher performance was actually achieved. That's a bad decision, one that will be captured and sanctioned by the MWR. And that's the beauty of an MWR. It is able to capture whether the decision to withdraw money was actually a good one or a bad one. So, again, this discussion should not lead you to say, then the MWR is always better. No. If it is the manager who is asking you to deposit money or withdraw money, then yes, I need to assess this manager regarding their timing abilities, regarding whether the decision of adding or removing money and how much is actually a good decision or not. So yes, if the manager controls these decisions, we need to use the MWR. Anything else would be unfair. If the manager does not control that decision, imagine you invest $2,000, you earn 11, then the manager says nothing. You decide as a client to withdraw the money, and then the performance is 26. Of course, the MWR will be low here, but it's not the manager's fault. It's not the manager who told you or who made you withdraw money from the account. You decided to withdraw money from the account. So when the manager controls the decision, MWR. When the client controls the decision, TWR. And do remember, please, that in many applications in real world applications, like in private equity, like in other types of real estate funds, etc., it is the manager who calls down capital. So yes, it is the manager who decides when and how much money to invest. Let's look at a last example, which is the same example that we covered earlier for the holding period rate of return, but where I specifically told you that you do not really need, or you don't actually need, assets under management. It is simply the geometric average of the holding period rates of return. Now for the money weighted rate of return, exact same example by the way, and as a reminder, the time weighted rate of return was 9.42. With the money rated rate of return, please always remember, you work with cash flows, not holding period rates of return. Now, if on the exam you have something like this, you just need to think about it carefully, because you are not given inflows and outflows. You are actually given assets under management at the beginning of the period. But that's fine, because given the holding period rate of return and next year's asset under management at the beginning of the year, you can calculate yourself the inflows and outflows to the portfolio. So let's do it step by step, because this is a more complex example in a way. So we started with $20 million. The holding period return is 10%. This means that you should end the year with 22. So at the end of year one, you should have $22 million under management. Now look at the beginning of year two, which is end of year one, right? Beginning of year two is end of year one. This is January 1 versus December 31st. So that's the same day, right? So here what I'm saying is the assets under management at the beginning of year two are only $21 million. Knowing that you earn 10% on 20, then you should have $22 million in the account. This clearly means that $1 million were withdrawn by the investor. So now I know that -1 is the cash flow. $1 million were withdrawn by the investor. And by the way, if 1 million were withdrawn from the investment portfolio, then this is a positive cash flow for the investor, because he or she got back $1 million. We continue. This is a step-by-step process. It's important to understand it. So now we start the beginning of year two with $21 million, on which we earn 20%. We should have ended the year at 25.2. We look at the beginning assets under management for year three, 25.2. So no funds were deposited into the portfolio and no funds were withdrawn. Cash flows, 0. It is important to note down this 0, because later on we will use a discounting approach, right? The money weighted rate of return is an IRR, so it matters that the next cash flow occurred at the end of year 3 and not end of year 2. That's why you must recognize that the 0 happens at the end of year 2, so that everything is kept accurate and time value of money is taken into account. Now, we look at the $25.2 million at the beginning of year 3. During year 3, it achieved 15%. So I should end the year 3 with 28.98 million. When I look at my table here, I'm ending year 3 with 30.98 million. This means that 2 million were actually added to the portfolio by the investor. Of course, this represents a negative cash flows, an outflow for the investor, because the investor is taking 2 million out of their bank account and investing them in the investment portfolio. Separate between the investor's pocket or bank account and investment account. right? So that's a -2 cash flow. Now we started the beginning of year 4 with 30.98 million. We lost 10% on those, so we must end the year with 27.88. When we look at the cash flows at the end of year 4, which is beginning year 5, we see that we have 30.882, which means that $3 million were added by the investor. This is again an outflow because $3 million left the investor's bank account and were transferred to the investor's investment account, right? This is an outflow for the investor. And finally, we started the beginning of year 5 with 30.88 million, on which we made 6% for an ending value of 32.73. Listen very carefully. They might not tell you on the exam, please consider that at the end of year 5, the portfolio is liquidated. But to calculate a return, you must consider that. You must consider that the 32.73 million, which is the value of the portfolio at the end of year 5, we stopped the investment horizon. It's as if we sold the portfolio for 32.73, and this is an inflow, a final inflow. That's the money back, actually. That's the money back to the investor. You now have all the cash flows that you need to calculate the money-weighted rate of return. So you open your cash flow function. The initial cash flow C0 is -20, no need to discount that. C1 is +1, C2 is 0, C3 is -2, and remember my comment to include the 0, or else the calculator would think that the -2 is occurring at the end of year 2. And then C4 is -3, C5 is 32.73, compute IRR. IRR is 7.36%. Now, of course, it is lower in that case than the time-weighted rate of return. It's not always the case, of course. Remember the 4 scenarios. So depending on which scenario happened, you will see that the money-weighted rate of return might be higher or lower than the time-weighted rate of return. Of course, here it's a bit trickier because you have several additions and removals from the portfolio, but very quickly, you could observe that when the client removed 1 million out of the portfolio, it was just prior to the best year of performance, right? And then when the client in year, the -10 here, if you look at the -10 in year 4, you see that the client deposited the largest deposit into the investment account just prior to the worst year of those 5 years. So you have a deposit prior to, or a withdrawal prior to a very good performance, and then you have a deposit prior to a very bad performance. And again, the money-weighted rate of return reacts to those deposits, to both the timing and size of those deposits, whereas the time-weighted rate of return does not. This is it for time-weighted versus money-weighted rates of return, when each is appropriate, how to calculate them, and how to make sure that when you calculate a time-weighted rate of return, you're looking at holding period rates. When you calculate money-weighted rates of return, you're looking at cash flows, and how each can be higher than the other depending on those 4 scenarios that we covered together. Thank you, and see you again very soon.